And then finally, our third main category that we invest in midstream energy. A lot of people historically have thought of this as MLPs. The MLP space is moving where we're seeing some C Corp conversions. We actually don't care. We're agnostic, whether it's C Corp or MLP structure. What we're really focused on is midstream energy. So we want to invest in the pipes and the gathering systems and the processing plants. We don't do any E&P exposure, none of the producers in this. We're really looking for more of the sustainable cash flows. And the MLP model is really evolving. If you kind of go back before the energy crisis in 15 and 16, the MLP market was all about growth, rapid dividend growth, rapid issuing equity to fund big capital expenditure growth projects. And it really was an unsustainable model. It was dependent solely on the capital markets providing them capital. Where the MLPs and the midstream energy space has moved today is they've moved to where they're retaining more capital, they're funding their capital growth expenditures with internally generated capital, and they're not issuing any equity today to fund their growth. And we think that that is a much more sustainable business model. And you can see at the top right-hand corner there of the distribution coverage, those numbers are pretty small on the right-hand side, but we're peaking out at about 160% dividend coverage. And if you rewind that back to 14 and 15, when the MLPs were growing rapidly, they were about 110% dividend coverage. What that provides is better, more consistent dividends, as well as being able to retain that capital to grow their business. And what we've seen is energy is completely out of favor today. It's out of the E&P producer stocks are getting crushed. The midstream energy stocks have come under significant pressure. As you can see here, we're at 9:30, we're trading at 10.8 times enterprise value to cash flow. This number updated today is sub 10%. Or sub 10 times, sorry. And so midstream energy is trading at near historical low valuations. Actually, in our portfolio, I'll show you here, we've actually been underweight midstream energy. The pie chart in the middle shows our current asset breakdown, where we're 34% BDCs currently, 13% midstream energy, 21% mortgage REITs, 11% preferreds, and 21% in cash today. We've been materially underweight MLPs all year. However, given to what we're seeing in terms of increased fundamental improvements in the space, as well as where the valuations are today, and we think there's probably a little bit more downside this year with some end-of-the-year tax loss selling, but we're getting close to the point where we're considering increasing our exposure to midstream energy. So we cut our midstream energy in half back in May, and the reasons for that we thought were what had been tailwinds in the MLP space of improving production volumes, particularly in the Permian, as well as U.S. becoming a trade exporter and seeing demand for exports. Those were tailwinds in 2018. We thought those were shifting for a couple of reasons. Number one, we thought that the trade dispute was going to have an impact on the export markets. We were seeing spreads between basins widen, and that was going to be more difficult for producers. In addition, we've been seeing this pressure on the producers to become cash flow, living within their cash flow means, and we thought that would reduce potential expectations for volumes in the space. So we cut our position in half on midstream energy. Since May, the midstream energy space has traded off 25%. What's interesting is we've actually seen EBITDAs continue to grow. So we just finished up third quarter EBITDAs. We saw EBITDA cash flows in the MLP space grow 7% year over year. We're seeing actually capital expenditures. We think 2019 is going to be the peak year for capital expenditures for MLPs. It'll decline somewhat in 20, and I think significantly in 2021, which I think will improve cash flows for the MLP space. And we're seeing distribution coverage ratios, now go to 1 and 1.55 times this recent quarter. So we're seeing those fundamentals increase while the market has been worried about the producers lowering their volumes. And so the market has become negative on energy because of concerns about volume productions. So, we're actually getting to the point where we think the market is worried too much about volume productions and not focused on that we're actually still seeing EBITDA cash flows improve and that capital expenditures are going to be lower in the next couple of years, which is actually going to help free cash flow. At current valuations, we would probably be inclined to pull the trigger now, but we've seen what's happened in the equity markets with strong returns in the S&P. People naturally look for tax loss selling, and the MLPs are a perfect spot for tax loss selling this year, being down 20% in a year where the market's up 20%. So we're being a little tactical on when we decide to increase our exposure there to the MLPs.